So welcome back to Lessons in Property with me, Steve Hand. And I've got Simon with us today. Now you might recognise Simon because he was here the other week talking with Joe, one of our bridging advisors, because he was bringing a project to Joe. But what I'd like to talk about this week is the insurances that are related to projects, because people come to us for the finance, but with that finance, you've got to take out certain insurances when you do a project, depending on what you're doing. So let's have a little chat about that, Simon. What are the basics, what are the essentials that people need?
I mean, the thing that you're going to have is builders insurance. If you're getting finance on a property from a lender, whether that's a mortgage or bridging or whatever the case, if you're borrowing money, they're going to want you to have builders insurance, because obviously if the worst were to happen and there was a fire, they've lent money against a building. If that's not there anymore, they don't like that.
No, I can see why.
So yeah, your buildings insurance, and we'll do it all. If you've got ground up, we can do that. If it's just buying a property, just doing a bit of general work on it, bathroom, kitchen, we can do that. We can literally any projects anyone's looking at. Most of them we'll be able to just do in-house, but if we can't, we'll just refer them out to insurers.
Okay.
Takes a little bit longer.
Yeah.
You know, if it's a sort of a ground up or something like that, then maybe take a week to get all the quotes in for that. But
yeah,
if it's just, you know, I've got a terrace and I'm looking to do a bit of work on it, and then I'm going to be renting it out in, I don't know, 3-4 weeks. Pretty quick.
Is it? And how different is it? Because as a landlord, like I've got a portfolio of properties that have landlord's insurance on, and let's say it's, I don't know, 150, 200 quid, typical kind of numbers per annum for that insurance. Bog standard terraced house. How would that look like for a flip, or if you're reconfiguring a property? Does it increase it considerably?
It can do. I mean, it depends what you're doing. So the things that the insurers look at is, first of all, how long has that property been unoccupied for? So quite a few insurers, if you say over 2 years, alarm bells start ringing for them, because they think it's going to be in a really bad state of, you know, damp.
Yeah.
You know, is it airtight? Is it watertight?
Mushrooms growing here and there.
Yeah. This is what they're thinking. So that can, if you say over 2 years, that does whittle down your insurers quite a bit. Which, as we all know in this world, if you start cutting out as many people that can supply you something,
the cost goes up.
Yeah. So that's the first thing they'll look at. Then they'll look at how long are you going to have it unoccupied for. So from completion, you know, is it going to take you a month, 2 months, 3 months, 4 months till you got it up and ready and rented out?
Yeah.
So that can make a difference to it. And then obviously what you're doing.
If it's a light refurb, bit of cosmetic work, not too much different.
Not too much, no. If you're doing structural, that can make a difference, quite a big difference. But yeah, it all of those things kind of make a difference. So I mean, if you were having one and doing, I don't know, let's say it was worth reinstatement value 150 grand and you were doing 30 grand's worth of work on it, I mean, you'd probably only, if you were looking at 150 normally for the year, you might be looking at 300-400.
Okay.
It honestly, there's so many different variants,
so many factors
it's difficult to go,
account.
It will cost you that.
And what if it was because some people purchase commercial buildings, refurb them into maybe a few apartments.
Yeah.
Does that increase it significantly? Is it a different type of insurance that's needed?
Again, less and less insurers. As soon as you go commercial, you lessen the amount of insurers that will do it, and where you're converting it as well. One of the ones that for some reason they don't particularly like is pubs. If you're converting a pub into residential, they're fine once it's all been ripped out. Yeah. But when it's still got the bar in it and things like that, a lot of insurers are like, no, I don't like it. Right. Don't know what the massive issue with it is. I honestly don't know, but a lot of them are turned right off by that. Right, so you just got to build that into your figures. But then, as soon as you've ripped out the bar, they're all right. Yeah, right, we'll do that. Okay.
And they don't like 500-year-old mills, do they either? I remember that one.
Yeah, my ones didn't like it. I had to go to somebody else basically to look at that for me. Yeah. Which ended up got it sorted for him. But yeah, it wasn't just the mill. There was a range of factors, and there was quite a lot of work being done on it, and the amount of work that was being done, and the cost of it, and the time scales, and all this. But yeah, that was a tricky one. I was getting some silly quotes for that, but then I just phoned somebody that I know that deals with, that's all they do is developments and big developments and ground up. That's their bread and butter. So
I guess there's everything right the way from a typical apartment, or which apartments have their own block buildings insurance anyway, don't they?
Not always. In Scotland, it's the factors, isn't it? And here, if you've got a management company, you can have buildings insurance as part of your
service charges
or factors, but it's not always the case. But the other thing that you've got to bear in mind is as well, if you go, oh right, I'm buying a flat, it's got buildings insurance as part of the management fees, and I'm renting it out. Well, that buildings insurance is just for, it's not, you've got no landlord's liability cover there.
Right.
So if one of your tenants then gets injured, that group policy is not going to have landlord's liability cover.
It's designed for owner occupiers typically.
Yeah, well, it's just there to insure the building. That's all it is. That's all the company cares about, is making sure the building's insured. You know, they don't care if you're living in it or you've rented it out or whatever the case may be. They're not going to give you the insurance for that. So that's when you have to either think, right, okay, do I just take out a little bit of contents insurance and then off the back of that I'll have landlord's liability, or just take out a public liability cover for your company.
Got you. So yeah, there's quite a lot of variances, isn't there, depending on terraced, flat, or whether it's a project, commercial, whether it's light industrial. There's so many different projects that we see here.
There's loads, and some of them, there's only one really that I can ever think of that I struggled massively, and it was an old military like boot hall sort of thing. But it was run down, like it had like 4 bricks in it or something. Do you know what I mean? There was not a lot there.
Proper ruin.
But the valuer had valued it at like, I think it was like 1.5 million for the reinstatement value, and they were doing a full knockdown rebuild. So the insurers were like, "There's no way we're covering rubble for 1.5 million."
Yeah.
And we struggled massively, and I don't think the person ended up purchasing because no one would insure it.
No.
Because well, why would you insure that for 1.5 million? Big risk.
So the insurance is a fairly big factor in whether you take on a project, if it's quirkier.
I think always check. It'd be highly unlikely, I think, that, as I said, that's one case that I can think of that it caused an out-and-out problem. So it's unlikely that insurance is going to be the reason for not purchasing something.
Yeah.
But, I mean, it's always good to check anyway, especially if your figures are tight.
Yeah.
If things are tight, then have a look, because
it can be a few grand, can't it?
It can it can be flagged up as a flood risk area.
Yeah.
You look on the actual government website and you're like, well, that's clearly not in a flood risk area, but the insurer goes, well, yeah, it is, and then they chuck the price up massively.
Yeah.
And if, as I say, if all your figures are very, very snug, then it might be a case of well, that's chucking it out into the realms of I'm not really that keen.
Yeah, interesting. So that's on the project side. There's all sorts of other insurances that you deal with, like...
Could look at them all, yeah.
Like take me, for example, I always pay my life cover the normal route out of your net income. And of course, with your advice, Simon, you made it very clearly evident to me that there was a much better way of doing it.
Yep. Pay for it through your limited company.
Yeah.
And then offset it against your corporation tax. Everybody likes to save on tax.
Oh, yes.
So, yeah, same premise. Life insurance pays out to whomever you want it to pay out to, but yeah, just pay for it through your limited company and offset it.
Happy days. So that's me, Simon Massey. Until next time, bye-bye.